Get a quick check on our markets this Tuesday and see how they're trading at the get-go. The Philippine Stock Exchange Index opens today 6,403, and that's about a decline of 0.1% at the get-go in the first 15 minutes of trading. PSEi started the shortened trading week with a gain of nearly 0.5%. Local counters were a mixed bag, with holding firms and services leading those gains, mining and oil leading the losses. Let's take a look at the Philippine Peso, see how that's going since 8 a.m. today. 55.75 to the dollar. Peso closed yesterday weaker at 55.81 against the greenback. As for the Philippine 10-year government bonds, they've inched up to 6.3% from the previous close of 6.279%. So what do the technical charts say about where to invest next in the Philippine markets? With us now for more is Ron Acoba, the Chief Investment Strategist at Trading Edge Consultancy. Good to see you, Ron. Welcome back to the program.
Hi, Ms. Kathy. Good morning.
All right.
Thank you for having me.
Yeah, second half of the year, and we're looking at a near 3% decline on the PSEi index, and that's after a whole lot of event risks, if you will. The April 2 Liberation Day tariffs, one Bangko Sentral policy rate cut last April 10th, the Philippine midterm elections, and May 12th, peso strength. So what did the chart say about how the PSEi traded, where it's going to go next in the second half this year?
Well, as you've mentioned, the PSEi on a year-to-date basis is down by close to 3%. If you look at it in the bigger picture, the index has been trading in a sideways pattern, not just over the last few months, but in fact over the last 4 to 5 years, between its low of around 5.8 to a high of around 7,500. So it's just been trading range bound between those two key levels. So it's not to say though that funds are not deploying their cash. It's just that they're not really keen on deploying it on a broad-based basis. Hence the flat performance of the index. So which goes to your question: where do we invest now? Where do we invest now, and how do we invest? Now, there are very noticeable performers on selected names. These are the likes, for example, of Meralco, Manila Water, Converge ICT, ICTSI, APX, and of course, DigiPlus. The common denominator among them is double-digit earnings growth. So while the rest of the market have been performing rather poorly or underwhelmingly, there are certain industries, or there are certain companies that have performed really, really well, and these are the ones that are really backed by robust earnings growth. And it's quite obvious that a lot of these funds have been putting a lot of money in those particular names.
Not so obvious ones. I mean, you've monitored one stock here closely. SDI Education Systems Holdings.
Yes.
Fundamentally looking supportive. I was looking at its earnings, 9-month income surging, 45%, more students enrolling in its schools. What's going on though technically?
Well, before we go into the technicals, you've touched upon its fundamentals. Over the last 3 years, SDI Education have had a compound annual earnings growth rate of around 54%. Imagine that, 54% earnings growth in the last 3 years, every year. In the last year alone, last school year alone, the company posted a significant earnings growth of 84%. For the present year, it's slated to post an increase of 34% in earnings. So, and even with that, the stock is only trading at what? 8 times PE. So it's growing at a very high clip, and its valuation, even if it's now trading at a 7-year high, it's still very much undervalued with a forward PE of just 8 times. So there's a lot of upside given the fact that it's slated to grow by another 34% this year and slated to grow by double digit again in the next 2 to 3 years. Technically, going to its charts, recently it's able to surpass its key resistance at 1.5 decisively with increased market participation. It's now trading at a new 7-year high. With that, it's positioned to revisit its all-time high at around 1.8 to 1.3. Not just revisit, but even surpass, given the fact that, as I've mentioned, growing its earnings at a very high clip uh, as of late.
Well, let's take a look at some of the cross bears here. Pretty interesting that our local currency has strengthened to 3.6% versus the dollar since the start of this year. So what does that tell us of where the peso is headed next in the second half?
Well, moving forward, firstly, technically speaking, the exchange rate is now hovering above its 18 months key support at around 55.3 thereabouts. In the past few weeks, the stock has the exchange rate has just been moving sideways. But with the BSP position to cut its interest rate in June 19, given the fact that domestic inflation has eased to 1.3% from 1.4% in the prior month, and with BSP potentially cutting, the interest rate differential with the US and the Philippines will narrow from 100 basis points to around 75 basis points, assuming the BSP cuts by 25%. That will actually weaken the peso. Hence, we will most likely see a rally in the US dollar peso exchange rate in the very near term. So there's a divergence between policies. The Fed is maintaining a wait and see mode. They will likely cut by September, not as early as June or July, while the BSP is already keen in cutting. So there's that divergence in policy, which will lead to a likely weakness in the peso in the very near term.
Right.
Overall, though, on a bigger picture, though, trend is still in favor of the peso, and a potential decline below the 55.3 support will likely lead it to its next support at 54.3, 54.2.
Now, how does that relate, Ron, with the bond yields? Because we've been looking at the divergence and potential decoupling. That word has often been said on this show. 10-year bond yield has really been confined to a narrow range of between 6.11 to 6.33% since reaching the peak on January 17th. That's a time Trump inaugurated on January 20th. How's it done since, and in correlation with the U.S. 10-year Treasury yields?
Well, if you look at the domestic peso bond yield over the last 3 to 4 years, it's just been trading sideways between around 6.2 to around 6.5 trading range bond in that particular trading band. It's basically stuck in that particular range because of the fact that the U.S. yields have also been stuck around 4.3, 4.4 over the past several months. If you recall, yields in the U.S. actually at one point spiked because of the credit rating downgrade. It was the news like a week or 2 weeks ago. So with U.S. yields stuck at a high clip of around 4.5 at 4 to 4.5 at present, it's likely that the domestic yields will also be stuck at this particular range.
All right,
even if the BSP is set to cut its interest rate. Because as you know, U.S. remains to be the Philippines benchmark.
That's true. And we're watching and waiting for the Bangko Central's decision on June 19th then. Well, thank you so much for providing that context and via charts. Very important on the data dive. Ron Acoba of Trading Edge.